Welcome, traders. Here's a question that might hurt. Why do 95% of traders fail? Welcome to Trading Psychology Edge, where we decode the mental game behind profitable trading. Quick disclaimer, everything I share comes from years of research and experience. But remember, trading involves risk. This is education, not personalized financial advice. Now, let's dive into something that could fundamentally change how you see markets. It's not lack of knowledge. It's not lack of tools. It's something simpler yet rarely discussed. Information overload. Every candle on your chart screams for attention. 4 data points per candle. Open, high, low, close. Multiply that by 200 candles per day. That's 800 pieces of information competing for your brain's processing power. But here's what nobody tells you. Your brain wasn't designed for this. The human mind can only effectively process 7 plus or minus 2 pieces of information at once. That's Miller's Law, established in 1956. Yet we're trying to process 800 data points while making split-second decisions with real money on the line. The result? Analysis paralysis, confusion, fear, and ultimately, losses. You've probably experienced this. You see a bullish engulfing pattern, but wait. There's a resistance level above. The RSI shows overbought, but May CD is bullish. Volume is increasing, but is it enough? While you're calculating, analyzing, second-guessing, the opportunity vanishes. Or worse, you enter late and get stopped out. This isn't an intelligence problem, it's a filtering problem. You're drowning in data when what you need is clarity. Today, we're diving deep into an 18th century Japanese solution that transforms chaos into clarity, Heiken Ashi. But more importantly, we'll explore the psychology behind why it works, and how mastering this tool can fundamentally change not just how you trade, but how you think about markets. Because here's the truth. The difference between the 95% who fail and the 5% who succeed isn't more information. It's better information processing, and that journey starts now. Chapter 2. The Trading Floor Chaos. Picture yourself on the NYSE trading floor in 1990. Hundreds of traders screaming, waving, signaling, each voice carrying different information. Buy orders, sell orders, rumors, facts, emotions, all mixed in one deafening roar. Can you make sense of it? No, nobody could. That's exactly what's happening on your chart right now. At the core of candlestick patterns lies the basic human emotions of fear and greed, which drive the market's fluctuations. Every regular candlestick captures all of it. Every panic sell, every FOMO buy, every algorithm's micro-adjustment, every nervous trader's stop loss. Think about this. In any given minute, thousands of market participants are acting on different information, different time frames, different strategies. Some are scalping for 5 pips. Others are building positions for months. High-frequency traders are making hundreds of trades per second. All this activity gets compressed into one candlestick. It's like trying to have a crucial conversation in a noisy bar. You hear every word, but also the music, laughter, glasses clinking, conversations from other tables. Your brain struggles to filter signal from noise. That's regular candlesticks. All signal mixed with all noise, no filter. Now imagine if someone gave you noise-canceling headphones that could filter out everything except the conversation that matters. Suddenly, clarity. That's what we're about to explore. But first, we need to understand why our brains fail us in these noisy environments. Because the problem isn't the market, it's how we're wired to perceive it. And once you understand this, you'll never look at a chart the same way again. Here's something that might surprise you. Your trading losses might have nothing to do with your strategy and everything to do with how your brain processes information. Let me ask you this. Have you ever seen a perfect setup, hesitated because of conflicting signals, then watched it play out exactly as you predicted? Comment below with just one word, yes, if this hits home. That hesitation, that's your brain drowning in noise. Keep watching to discover how to silence it. The journey from chaos to clarity begins with understanding the chaos itself. Chapter 3. The Psychology of Price Action. Let's dissect the psychology behind price movements. Market participants' emotions, such as fear and greed, lead to patterns that provide valuable insights into potential market movements. But these insights are often buried under layers of noise. Think of financial markets as a battlefield between buyers and sellers. Buyers bet on rising prices, pushing them up through their trades. Sellers bet on falling prices, pushing them down with their selling interest. Simple enough, right? But here's where human psychology complicates everything. Recency bias. We overweight the most recent candle. That red candle that just closed? Your brain screams, trend reversal. But zoom out, it's just noise in a strong uptrend. This bias evolved to help our ancestors survive immediate threats, but in trading, it's deadly. Your brain treats every red candle like a saber-toothed tiger. Except, tigers didn't cost you $500 per encounter. Confirmationness. Traders can become emotionally attached to specific patterns. Got a long position? Every tiny green candle becomes confirmation. Every red is just a pullback. Your brain actively searches for evidence supporting your position while ignoring contradicting signals. It's not stupidity. It's human nature. Analysis paralysis. Too much information leads to no action. You see a bullish engulfing, but wait, there's a bearish wick. What about volume? RSI shows overbought, but MACD is bullish. The 50 EMA is support, but the 200 EMA is resistance. While you're analyzing, opportunity passes. Here's the cruel irony. The more information you have, the worse your decisions become. Studies show that beyond a certain point, additional information doesn't improve decision quality, it degrades it. You become more confident, but less accurate. This is why even smart, educated traders fail. They're not lacking intelligence. They're drowning in data, fighting their own psychology, trying to process the unprocessable. What they need isn't more indicators or better analysis. They need a way to see through the noise to what really matters. Let me share something personal here. Early in my trading career, I had 6 monitors, 15 indicators, and lost money consistently. The turning point? When I reduced my setup to just 2 screens and 3 key tools. Less information, better decisions. Has information overload ever paralyzed your trading? Drop a comment. Paralyzed if you've been there, or still struggling if you're fighting this battle right now. There's no shame in admitting it. Recognition is the first step to transformation. Chapter 4. Market Sessions and Emotional Cycles. Market psychology shifts dramatically throughout the day. Understanding these emotional cycles is crucial for why Heiken Ashi excels in scalping. Each session has its own personality, its own rhythm of fear and greed. 9:30 a.m. Opening bell. The first 30 minutes are pure emotional chaos. Overnight news, pre-market moves, gap plays, amateur orders, professional positioning. Everything collides at once. Candlestick patterns reflect the collective emotions and actions of traders in the market. But at the open, these emotions are raw, unfiltered, extreme. Regular candles whipsaw violently up, down, up, down. Each candle tells a story, but they're contradictory stories. One says breakout, the next says fake out, the third says reversal. What's the real story? In this chaos, even experienced traders get chopped up. Mid-morning, 10:30 a.m. to 12:00 p.m. Emotions begin to settle, initial positions are established. Institutional algorithms activate, following their programmed rules. But regular candles still show every minor pullback, every small profit-taking wave, as if they're significant. How do you distinguish real moves from market breathing? When everyone who wanted to buy at the open has bought, and everyone who wanted to sell has sold, what happens next? This is where the real trend often emerges, but it's hidden in the noise. Lunch hour, 12 to 2 p.m. Volume drops dramatically. Liquidity dries up. Major players are literally at lunch. Every small retail order can move price significantly. Regular candles during this period, misleading at best, dangerous at worst. The moves look significant, but they're just ripples in a shallow pool. Ever noticed how your worst trades happen during lunch? That's not coincidence. It's psychology meeting low liquidity. Power hour, 3 hours to 4 p.m. Portfolio rebalancing floods in. Institutional traders who've been patient all day finally act. Regular candles go wild again, but this is organized chaos. There's pattern, logic, purpose. If only you could see through the noise to the underlying institutional intent. Each session requires different psychology, different tools. What works at open fails at lunch. What fails at lunch thrives in power hour. This is why one-size-fits-all strategies fail. You need adaptive tools that match market psychology. Chapter 5. Enter Heiken Ashi, the historical solution. Heiken Ashi, meaning average bar in Japanese, was developed by Munehisa Homma in the 1700s. But to understand its genius, we need to understand the man behind it. Homma wasn't just a trader. He was a psychologist before psychology existed as a field. Trading rice futures in Osaka, he noticed something profound. Market movements weren't random. They followed patterns based on human emotion. Homma observed the influence traders' emotions had on their trading decisions and identified the impact of sentiment on markets driven by fear and greed. But his genius wasn't in identifying emotions. Everyone could see when traders were fearful or greedy. His breakthrough was recognizing that not every emotional spike matters. Think about it. In any market at any moment, someone is panicking, someone else is getting greedy, someone is taking profits, someone is averaging down. If you react to every emotion, you'll be whipsawed constantly. But if you could see the average emotion, the consensus of the market, understanding the psychology driving price trends put him at an advantage to other traders, as he outlined in his 1755 book, The Fountain of Gold. He wrote, "When all are bearish, there is cause for prices to rise. But how do you know when all are bearish versus just some noisy traders?" His solution was elegant. Don't react to individual emotions. React to the average. Filter out the extremes. See what the market as a whole is feeling, not what the loudest voices are screaming. This principle, averaging to find truth, appears everywhere in science. Signal processing uses it. Statistics uses it. Your smartphone camera uses it to reduce image noise. And 300 years ago, a Japanese rice trader used it to revolutionize trading. Basically, Homma was running a noise-canceling algorithm before computers existed. Sometimes the best solutions are the timeless ones. The question is, if this principle is so powerful, so universal, why do 95% of traders still use noisy, unfiltered data? The answer lies in understanding not just what Heiken Ashi does, but how it changes your psychological relationship with the market. Chapter 6. The Mechanics of Emotional Filtering. The Heiken Ashi technique averages price data to create a Japanese candlestick chart that filters out market noise. But let's understand the psychology behind the mathematical transformation. The averaging effect. Heiken Ashi. Close is the average of open, high, low, and close, OHLC, of the current period. Think about what this means psychologically. Instead of showing you where price ended, regular close, it shows you the average sentiment throughout the period. Imagine polling people about their mood. Regular candles would only record the last person's answer. Heiken Ashi records everyone's average, which gives you a better picture of group sentiment. The emotional spikes, that panic sell at the low, that FOMO buy at the high, get smoothed into the overall consensus. The continuity principle, Heiken Ashi. Open is the average of the previous Heiken Ashi candles open and close. This creates narrative flow. Each candle connects to the previous one, forming a coherent story instead of choppy chapters. In regular candles, each period starts fresh, creating gaps and discontinuities. It's like reading a book where each page was written by a different author. Heiken Ashi creates continuity, like one author telling one story. Your brain can follow the plot instead of constantly readjusting. Color consistency creates confidence. In an upward trending market, Heiken Ashi shows a progression of green candlesticks with no lower shadow. Imagine the psychological impact. Instead of mixed signals causing doubt, your brain receives one clear message: trend is up. Stay long. This isn't about simplifying to the point of missing information. It's about presenting information in a way your brain can actually process effectively. Just as a good editor doesn't add words but removes unnecessary ones, Heiken Ashi doesn't add data but removes noise. Quick test for you. Think about your last losing trade. Was it because you didn't have enough information or because you had too much? If too much information has ever cost you money, type TMI, too much information, in the comments. I'm betting we'll see a lot of TMIs down there. Why? Because that's the real enemy of profitable trading. The result? Reduced cognitive load, clearer decisions, better trading. Chapter 7. The Psychology of Smooth Price Action. Heiken Ashi charts smooth out price action, making it easier to spot trends and reversals when trading. but the real transformation happens in your mind. Reduced whipsaws equals reduced stress. Every false signal triggers your fight or flight response. Cortisol floods your system. Decision-making degrades. The Heiken Ashi technique reduces false trading signals in sideways and choppy markets, keeping your stress hormones manageable. You stay in the cognitive zone, where good decisions happen. Clear trend identification equals increased confidence. Doubt is the trader's enemy. When you see a string of green Heiken Ashi candles with no lower wicks, doubt disappears. Your brain stops second-guessing and starts executing. Confidence isn't about being right all the time. It's about clarity in your decision-making process. Fewer false signals equals better decision-making. Your brain has limited decision-making capacity. Psychologists call it decision fatigue. Every choice depletes this resource. By filtering out false signals, Heiken Ashi preserves your mental energy for the decisions that matter. You're not exhausted by noon from analyzing every tick. But here's the brutal truth. Knowledge alone isn't enough. You can understand Heiken Ashi perfectly. You can see the cleaner signals. You can appreciate the psychology. But without discipline, you'll still fail. Because in that moment when money is on the line, when your heart is racing, when FOMO screams in your ear, theory crumbles. Only disciplined practice survives. Knowing and doing are separated by an ocean of emotion. Heiken Ashi is your bridge across that ocean, but you still have to walk across it. And that journey from understanding to application is where most traders fall. Here's where it gets personal. I remember my first week using Heiken Ashi. The signals were so clear, I thought I'd found the holy grail. Then I started over trading because every signal looked good. The tool was better, but I wasn't. It took 3 months of disciplined practice before Heiken Ashi transformed from a clever indicator into a profitable edge. The tool doesn't make you profitable. How you use the tool does. The next chapter isn't just important. It's the difference between joining the 95% who know but fail and the 5% who know and succeed. Chapter 8. Building Trading Discipline. Here's where Heiken Ashi transforms your trading psychology from reactive to responsive. From reactive to responsive. With regular candles, every tick is temptation. Green tick, maybe this is the bottom. Red tick, the trend is over. You're not trading, you're reacting. Like a pinball bouncing between bumpers, each price movement sends you in a new direction. Heiken Ashi forces a different relationship with price. When colors don't change with every minor fluctuation, you stop reacting to noise. You start responding to actual trend changes. It's the difference between flinching at every sound and turning only when someone calls your name. The power of delayed gratification. Heiken Ashi teaches you delayed gratification, a core factor for success in any field. Remember the Stanford marshmallow experiment? Children who could wait for 2 marshmallows instead of eating one immediately showed greater success in life across every metric: SAT scores, career achievement, even health outcomes. Trading is no different. When Heiken Ashi changes from red to green, it's tempting to enter immediately. But waiting for the second confirming candle, that's choosing 2 marshmallows. That's professional trading. The comparison that changes everything. Entering early equals shooting blind in the dark. Entering after 2 Heiken Ashi candles equals shooting after radar confirms the target. Those extra moments of waiting aren't lost opportunity. They're invested in certainty, and certainty, not speed, builds wealth. Think about master chess players. They don't move quickly. They see the board clearly, understand the patterns, then act decisively. Heiken Ashi gives you that same clarity in trading. You stop playing speed chess with the market and start playing strategic chess. This shift from speed to strategy, from reaction to response, is what separates amateur traders from professionals. And it starts with the simple act of waiting for 1 additional candle. Challenge time. Next time you see a Heiken Ashi color change, can you wait for the second candle? Not because I told you to, but because you understand why. If you're ready to trade like a chess master instead of a slot machine player, comment strategic, not speedy below. This isn't just a comment, it's a commitment to yourself. Chapter 9. The 3 questions. Framework. Every time you analyze a chart, your mind faces thousands of micro decisions. Heiken Ashi simplifies this to 3 essential questions that cut through the complexity. Question 1. What's the trend direction? Look at Heiken Ashi colors over the last 10 to 20 candles. This isn't about finding perfect trends. It's about seeing the dominant force. Predominantly green, buyers control the narrative. Predominantly red, sellers are writing the story. Mixed colors, no clear author, stay out. The beauty is in the simplicity. Your brain doesn't need to weigh conflicting signals. Green means green, red means red, mixed means wait. This clarity transforms analysis from stressful puzzle solving to calm observation. Question 2. How strong is the momentum? Heiken Ashi reveals momentum through body size and shadows. Hollow or green candles with no lower shadows indicate a strong uptrend. Buyers are so dominant that sellers can't even create lower wicks. These aren't just candles, they're expressions of market conviction. Long bodies show strong momentum, the market moving decisively. Short bodies signal weakening momentum, the market catching its breath. This isn't technical analysis, it's reading market body language. Question 3. Is there a reversal signal? In regular candlesticks, every doji or hammer might be a reversal. In Heiken Ashi, these patterns carry more weight. Candles with small bodies surrounded by upper and lower shadows indicate genuine indecision, not just momentary hesitation. When Heiken Ashi shows a doji after a trend, it's not one trader's uncertainty, it's the market's collective pause. These 3 questions replace analysis paralysis with structured thinking. Instead of drowning in data, you're systematically extracting what matters. It's the difference between trying to drink from a fire hose and sipping from a filtered stream. Master these questions and you'll find yourself making decisions faster, with more confidence, and surprisingly, with better results. Chapter 10. Entry Criteria, the Psychology of Certainty. Heiken Ashi. Entry rules aren't arbitrary. They're psychologically optimized for clarity and conviction. Each rule addresses a specific cognitive bias that destroys traders. Rule 1, color change confirmation. Never enter on the first color change. Always wait for the second candle of the same color. This rule fights your brain's pattern-seeking addiction. Humans see patterns everywhere, even in random data. One green candle after reds, your brain screams reversal. But patterns need confirmation. The second candle isn't about being conservative, it's about being certain. A change in color doesn't always mean the end of a trend, it could just be a pause. That second candle separates pauses from reversals, noise from signal, hope from probability. Rule 2, body size requirements. Entry candles must have bodies at least 50% of them total candle length. Why? Because body size reflects conviction. Small bodies mean the market is uncertain, torn between buyers and sellers. Large bodies mean one side has taken control. Entering on small-bodied candles is like building on sand. There's no foundation. Large bodies are bedrock, solid ground for your position. This rule protects you from your own eagerness, forcing you to wait for genuine market conviction. Rule 3, shadow analysis. In uptrends, ideal entry candles have no lower shadow. This shows buyers in complete control. Sellers couldn't even push price below the open. It's not just a technical point, it's a psychological one. When sellers can't create lower shadows, they've given up. The path of least resistance is up. These aren't arbitrary filters, they're cognitive guardrails. They protect you from yourself, from your biases, from your emotions. By following them religiously, you transform from emotional trader to systematic executor. The beauty? These rules are simple enough to follow under stress, and specific enough to be actionable, and powerful enough to keep you on the right side of trends. Here's a thought experiment. How many of your losing trades violated at least one of these rules? If you entered on first color change, small bodies, or ignored shadows, type the number below. I'm guessing the correlation between rule violations and losses will be eye-opening. Sometimes the best trading improvement isn't learning new strategies. It's following the rules of the strategy you already have. Chapter 11, Risk Management Psychology. Stop loss is not a number, it's a story break. This profound truth transforms how you think about risk management. Traditional stop losses are numerical, 2% below entry or 20 pips. These have no meaning beyond math. Heiken Ashi stop losses are structural. They represent narrative changes in market story. The psychology of structural stops. When you place stops below the low of a Heiken Ashi signal candle in uptrends, you're not picking an arbitrary level. You're identifying where the bullish story breaks. If price falls below this level, buyers have lost control. The narrative has changed. Exit isn't failure, it's acknowledgement of new information. This psychological shift is crucial. With numerical stops, hitting your stop feels like failure, like the market got you. With structural stops based on Heiken Ashi, hitting your stop means the market story changed. You're not wrong, you're adaptive. Breaking the revenge cycle. When stops are logical rather than arbitrary, you don't feel cheated when hit. There's no anger, no need for revenge. You simply accepted that this story ended and prepare for the next one. This breaks the destructive cycle of holding losers, then regret, then revenge trading that destroys accounts. Clean losses. Enable clean wins. Professional traders talk about clean losses, losses that don't contaminate your next trade with emotional baggage. Heiken Ashi stops create clean losses because they're based on market structure, not hope. When you exit because the market narrative changed, you're free to read the next story without bias. The ultimate truth? Risk management isn't about avoiding losses, it's about taking the right losses for the right reasons. Heiken Ashi makes those reasons crystal clear, transforming risk management from painful necessity to logical process. Let me share a breakthrough moment. I used to move my stops based on fear. Price would approach my stop, and I'd move it just a little lower to avoid the loss. Result? Small losses became big losses. With Heiken Ashi structural stops, I finally understood. The stop isn't there to hurt me. It's there to tell me when the story I'm trading no longer exists. Once I accepted this, I stopped moving stops and started taking small, clean losses. Ironically, my wins got bigger because I wasn't carrying emotional baggage from avoided losses. Chapter 12. Real-World Application. The two approaches. Let's examine how different charting approaches affect real trading decisions in live market conditions. The regular candlestick challenge. The main purpose of Heiken Ashi is to reduce noise in charts. Without this noise reduction, traders face multiple color changes creating false signals, emotional whipsaws from every minor price movement, and difficulty holding positions during normal market breathing. Picture this. EUR/USD at the London Open. Regular candles show green, red in rapid succession. Each change triggers an emotional response. Enter long, stopped out. Enter short, stopped out. By 10 a.m., you're down 3 trades and emotionally exhausted. The market hasn't even begun its real move. The Heiken Ashi advantage. The advantage of Heiken Ashi candlesticks is that they make trends clearer and help nervous traders remain with dominant trends. Same EUR/USD open, but through Heiken Ashi. First hour shows small-bodied candles with wicks. Clear message, no trend yet. Then solid green candles emerge with no lower wicks. Entry signal clear. One trade, riding the London momentum. Research validated results. According to backtesting data, EUR/USD 4-hour time frame historical data from 2000 to 2014 showed profitable results using Heiken Ashi with ATR-based stops. Identifying candlesticks with no shadows proved a credible signal for strong trend beginnings. This strategy demonstrated consistent performance and high success rates. Critical understanding. When markets change direction, Heiken Ashi candles react more slowly. This disadvantage is actually a feature. It prevents premature exits from profitable trends. You sacrifice perfect entries and exits for staying power in trends where real money is made. The professional approach isn't about catching every move. It's about catching the right moves and staying with them. Heiken Ashi excels at this essential task. Chapter 13. The Transformation Journey. Heiken Ashi isn't magic. You still need mastery. Let me map the transformation journey every successful Heiken Ashi trader experiences. This isn't theory, it's the predictable path from novice to professional. Stage 1. The honeymoon, weeks 1 to 2. You discover Heiken Ashi. Charts suddenly make sense. Trends appear obvious. You catch several good trades. Confidence soars. Why didn't I find this earlier? This is when the illusion of skill is strongest. You attribute luck to the tool, not recognizing you're still in the learning curve. Stage 2, the Valley of Reality. Weeks 3 to 6, reality hits. Heiken Ashi shows clear signals, but you still lose. Why? Because you're bringing old psychology to a new tool. Still entering too early, 1 candle instead of 2. Still refusing to wait during consolidation. Still moving stops based on fear, not structure. This is where 80% quit, declaring, Even Heiken Ashi doesn't work. Stage 3, the breakthrough, week 7 to 12. Something shifts. You stop trying to outsmart Heiken Ashi and simply follow its rules. 2 candles for confirmation. You wait. No trend during lunch. You close the laptop. Stop at structure. You place it and forget it. The revelation, Heiken Ashi doesn't teach you to win. It teaches you to hold steady when winning and learn effectively when losing. Stage 4, professional habits, month 4 and beyond. Trading becomes systematic. Morning routine. Check Heiken Ashi trend, not P&L. Decision process, signal first, opinion second. Loss reaction. What did the market story tell me? Win reaction, stay humble, follow the system. The ultimate realization. You're no longer watching candles, you're reading market poetry, written in patterns of fear and greed, translated by Heiken Ashi into clear prose. This isn't just trading evolution, it's psychological transformation. Where are you on this journey? Type your stage number, 1, 2, 3, or 4 in the comments. No judgment here, we all start at stage 1. What matters is recognizing where you are so you know what comes next. And if you're in stage 2, the valley of reality, don't quit. That's where the real learning happens. The breakthrough is closer than you think. Chapter 14. This week's assignment. Knowledge without application is worthless. This week's assignment transforms understanding into experience. Your 5-day challenge. Day 1 to 2, observation phase. Set up dual charts, regular candlesticks on left, Heiken Ashi on right. Same instrument, same time frame. During active market hours, spend 30 minutes simply observing both. No trading, just watching. Notice, how many times do regular candles change color versus Heiken Ashi? When regular candles show chaos, what does Heiken Ashi show? How does each chart make you feel, stressed or calm? Day 3 to 4, pattern recognition. Continue dual chart observation, but now identify. Every time regular candles would trigger a trade entry, whether Heiken Ashi confirms that entry, the difference in stop-loss placement between methods, count false signals on each chart type. Day 5. Integration review your notes. Calculate how many trades would regular candles generate versus Heiken Ashi. What percentage of regular candle signals did Heiken Ashi filter out? Which approach aligned better with actual market moves? The deeper exercise. Each day spend 5 minutes journaling your emotional state while watching each chart. Are you calmer with Heiken Ashi, more confident, less triggered by every price movement? This emotional awareness is as important as technical understanding. Remember, this isn't about proving Heiken Ashi is better. It's about experiencing how different tools create different psychological states. And in trading, psychology is everything. Don't trade this week, just observe, learn, internalize. Next week, you'll be ready to apply what you've absorbed. Chapter 15. The path forward. We've reached the summit of our first mountain, but the view reveals more peaks ahead. Trading isn't about prediction, it's about perception. Today you've learned how Heiken Ashi transforms perception by filtering emotional noise. But clarity alone isn't enough. You need context. You need to know where the market is, not just where it's going. Most profits are generated when markets are trending, so predicting trends correctly is necessary. Heiken Ashi helps you see those trends clearly. But seeing the trend is only half the equation. The other half, understanding where you are within that trend. Next episode, we explore the second tool in our Trinity system, VWAP, Volume Weighted Average Price. If Heiken Ashi tells you market direction, VWAP tells you market location. When you know both direction and location, that's when professional trading begins. What you'll discover. Next time, why 90% of retail traders consistently buy high and sell low, and how VWAP reveals this trap. How institutional traders use VWAP as their North Star for entries and exits. The exact strategy for trading VWAP bounces with Heiken Ashi confirmation. Why the combination of Heiken Ashi plus VWAP creates a sum greater than its parts. Your evolution continues. Today you learn to see through noise. Next time, you'll learn to see market structure itself. Together, these tools don't just improve your trading, they transform how you think about markets. The market will be there tomorrow, but will you see it differently? You now have the first piece of the puzzle. The question isn't whether Heiken Ashi works, it's whether you'll commit to mastering it. The 5% who succeed aren't smarter, they're not luckier. They simply see more clearly and act more decisively. But here's my final challenge for you. Knowledge without community is like trading in isolation. You've just spent an hour diving deep into market psychology. Now I want to know, what was your biggest aha moment? What concept shifted your perspective? Share it in the comments below, because when one trader's insight becomes another's breakthrough, we all rise together. If you're serious about mastering the psychological edge in trading, subscribe and hit the notification bell. Not for the algorithm, but because next week's VWAP episode builds directly on today's foundation. Miss it, and you'll have half a system. Master both, and you'll have what most traders spend years searching for: a clear, systematic approach to reading market psychology. Remember, the market speaks in patterns of human emotion. Today you learn to hear its true voice through the noise. Next week, you'll learn to understand what it's really saying. Trade with clarity, execute with conviction. I'll see you in the transformation. Bonus, Chapter 16, The Inner Heiken Ashi. Before we part, let me share something profound. Heiken Ashi isn't just a charting technique. It's a mindset you can apply to life itself. The Heiken Ashi mindset principles: simplified decision-making processes. Just as Heiken Ashi averages price data, you can average life's noise. Don't react to every email, news flash, or market move. Create decision filters. Does this align with my core strategy? Wait for confirmation in relationships, business decisions, and yes, trading. Single data points lie. Averages reveal truth. Practice observation. Before reaction. The gap between stimulus and response is where wisdom lives. See the first signal, like the first color change candle. Pause and observe, wait for the second candle. Then act with conviction, enter with confidence. This principle applies whether you're facing a market setup, a business opportunity, or a life decision. Reduce volatility expectations, increase stability focus. Most traders fail because they're addicted to action, excitement, the adrenaline of constant decision-making. Heiken Ashi teaches us, boring is profitable, consistency beats brilliance, smooth progress outlasts dramatic swings. In trading and life, sustainable success comes from reducing volatility, not seeking it. The ultimate truth: when you internalize Heiken Ashi principles, you don't just become a better trader, you become a more centered, patient, and profitable human being. Your charts begin to reflect your inner state: calm mind, calm charts. Clear thinking, clear trends. That's the real secret of the professionals. They don't just use better tools, they've become better decision makers. The tool is just an extension of their evolved mindset. Next episode, we'll add another layer to this mindset with VWAP, understanding not just where we're going, but where we are. Until then, practice seeing through the noise. In trading, in life, this is your journey to clarity. The journey continues.